Hey! Hi guys, and welcome to Macro Markets, where we analyze how the macroeconomic news and events impact the crypto space. I'm your host, Marcel Pechman, veteran stock markets trader and analyst at Cointelegraph. Today's show will start by discussing the latest move by the Turkish central bank. Turkey's central bank hikes interest rate to 15% in dramatic U-turn to fight inflation. The whopping 650 basis point rate increase is the country's first since March 2021, but was below analyst expectations of a 1,150 basis point hike to 20%. Okay, so you might not be aware of what happened to the Turkish economy in the past 5 years, but the bottom line is their local currency, the Turkish lira, dropped by 80% against the US dollar. The reasons include a long period of artificially low interest rates, excessive government spending, and government intervention in the FX market to prop up the Turkish lira. So basically, they have been using the country's reserves to try to contain the devalue of the local currency. So they spend dollars using that, and now their reserves are depleted. The article cites an analyst from Turkey Raporu. So this is an attempt to take the country back to an orthodox monetary policy and reduce inflation in the meantime, and get some space to start fixing the macroeconomic problems and roll back some of the policy that has been implemented in the lead up to the election. When economists mention orthodox monetary policy, they mean the central bank is aiming for lower inflation and stabilizing the local currency. Those pseudo-scientists recur to multiple tools to minimize the negative side effects from overspending, government overspending, but they seldom force those governments to cut back on spending and let the free market decide on interest rates. Why? Because one of the main benefits from being in power is controlling money. People tend to believe that printing money is the only method that politicians exert direct power, but that's far from true. For instance, government subsidies for certain sectors and companies yield a similar result, a similar power, as the beneficiaries, the companies, would no longer have to pay the same taxes as their competitors, whether they're domestic or foreign. So it's basically just government handing out money to some of their friends or political allies. Furthermore, by implementing artificially low interest rates, the government can direct the lending from some state-controlled financial institution toward their allies. Those families and companies getting the special treatment, the long-term financing from government, will almost certainly profit regardless of the money being effectively used in their core business. For instance, if the interest rate for a regular loan, 1-year loan at a bank, costs 20% per year, and you have access to the government loan, a 3-year or 5-year term at 15% per year, you get the money from the government and you reinvest it on the market. You get a free 5% per year, risk-free, without doing anything. Okay, so what can we learn from the Turkish experiment? Well, the episode shows how quickly a government can cause 80% losses for its currency. You've got to remember that India, China, Indonesia, Pakistan, Bangladesh, and Philippines entices 46% of the global population. So it doesn't matter if the US dollar holds its dominant position as a global reserve status. Turkey's and Argentina's 70% inflation in the last year, 2022 alone, are perfect examples of how decentralized cryptocurrencies might be the sole lifeguard for hundreds of millions, if not billions, that have no ability to save and transact in foreign currencies. You might think that all one had to do when facing domestic currency devaluation is buy dollars or euros, but those governments tend to place restrictions and taxes on how much you can convert or send abroad. We must realize that fiat money, no matter if the local currency dollars or euros, are controlled by governments, and as it limits the cash use, the physical money, it will become exponentially difficult for citizens of developing countries to bypass the government restrictions. Right now, it's easy to get US dollars cash in Brazil or Argentina or Turkey. But as the governments insert some ban over the physical money use, it will be much harder for these guys. So the need for an asset that can't be confiscated will suddenly become more evident for the majority of the global population as the inflation soars and as those developing countries' local currencies devaluate against the US dollar and euros. Remember, economists and the traditional media will try to blame inflation on everything possible except on the government excessive spending. They want you to believe that external factors, macroeconomic conditions, or whatever cause the depreciation of their currencies. So make sure to save in hard money, whether it's in residential real estate, gold, Bitcoin, or investing in the S&P 500 companies and the index. Remember, that's not investment advice, nor Cointelegraph official view, that's only Marcel's opinion. Now let's move to China, the second largest global economy. Goldman joins Wall Street banks in cutting China's growth outlook as post-Covid bounce fades. Goldman Sachs cut its forecast for China's full-year GDP, gross domestic product, from 6% to 5.4%. While the firm sees further stimulus to come, it notes that the measures will not be enough to overcome the greater problem that it faces: weakened sentiment. With continued challenge from the property market, the real estate market, pervasive pessimism among consumers and private entrepreneurs, and only moderate policy easing to partially offset the strong growth headwinds, we mark down our 2023 real GDP forecast. Okay, you ought to be questioning, what is the relationship between Chinese markets and crypto? Because everyone uses the US S&P 500 as the standard correlation metric. Well, it turns out the MSCI China Index, the stock market in China ETF, has been a better proxy to Bitcoin's performance. I'll show you a chart showing how correlated both assets are starting from October 2021. While Bitcoin, the orange line, traded at its all-time high in November, nearly at $70,000, the Chinese stock market ETF, the MSCI China, the blue area, hit $72. From there, both faced a strong correction, bottoming nearly at the same time 1 year later, between October and November 2022. You can see here the blue line is the MSCI China bottoming, and the orange line marks the Bitcoin price bottom near $15,500. And why should we care about the Chinese economy in the first place? Well, for starters, it holds the largest foreign exchange reserves in the world at $4 trillion, and the second largest global financial market, valued at $20 trillion. Moreover, out of the 500 largest companies in the world, 150 of them are based in China. Having said that, odds are, if the Chinese stock market goes down, so will cryptocurrencies, or at least their prices will be heavily pressured. Now, China has some uniqueness that might help fueling cryptocurrency adoption, whether or not their government wants. Firstly, the digital banking and mobile internet connection have an incredible penetration even in rural areas. In total, 92% of the population in China used mobile payment services in 2022. But, more importantly, the government is already testing its CBDC, the central bank digital currency. Their pilot program has reached 260 million wallets, encompassing 25 cities. So, even though Alipay and WeChat Pay remain dominant, most likely the population will be forced in the future to use the digital yuan as their primary or secondary wallet. You might think this is a threat to decentralized cryptocurrencies, but this is exactly the opposite. Firstly, whenever there's a recession, or in China's case, a smaller than expected growth, governments tend to boost socio-economic programs. And what better way to enforce the CBDC adoption? So instead of handing out money or checks, they can easily tell the population, well, download this app, install your wallet, and you're gonna get $100 in digital yuans every month, etc. So to roll out the CBDC in this way is much easier. Okay, so why is the CBDC a net positive for crypto? Well, for starters, it is very difficult to block someone from using their stimulus checks to buy cryptocurrencies. Sure, an intermediary might be needed to bypass the CBDC restrictions, but nature finds a way. Maybe the person buys cleaning products using the CBDC and resell them on marketplaces for stablecoins. The very own limits imposed by the government on CBDC use will serve as an advertisement for decentralized cryptocurrencies. Once they're no longer allowed to buy their favorite games and apps or restricted from sending money abroad, they might look for alternative solutions. Make no mistake, the government cannot ban Bitcoin, even if the CBDC gets implemented. They might create one or two additional steps to buy cryptos, like sending money abroad or recurring to P2P, the peer-to-peer traders, but those interests will eventually bypass the restrictions. Well, that's it for today. I hope you enjoyed the show. Make sure to like and subscribe the new Cointelegraph Markets and Research YouTube channel. See you!